Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to a break-even analysis as well as a problem for fixed costs and variable costs allocation between fixed costs and variable costs. Get ready, it's time to take your chance with Corporate Finance. Here we are in Excel. Note that we have two tabs here. We got the Practice 1, Practice 2. You may have 4 tabs in your Excel worksheet if you're following along with this, 2 with the answers, 2 with the worksheet that will look like this. This is going to be the first tab where we will work a break-even point analysis problem, very similar to a prior presentation. Then we're going to take a look at this second tab here, which will be going into the fixed cost and variable cost allocation quickly. To review that, we'll go a little bit faster back to the first tab for the break-even point. Once again, this is a fundamental kind of calculation, so we just want to be able to understand this very well when we're thinking about projections into the future. And in order to do so, you got to turn your mind off of the financial accounting kind of framework, put your mind towards the income statement on more of a what I would call a contribution margin type of income statement, or one that is allocating costs not in accordance with what they are used for, but by behavior, 2 categories of behavior, those being variable costs and fixed costs. Now, again, it's not perfect that everything can fall into the 2 categories of variable costs but fixed costs, but we're going to do our best to do so, because if we can do so, the predictive power into the future is much easier and useful for that. So we have the break-even point. So the break-even point will be the fixed cost divided by the sales price minus the variable cost, or in other words, the contribution margin per unit. So when you hear that word contribution margin, remember you got to break it out between whether they're talking about the contribution margin total, which is the sales minus the variable costs total, or contribution margin per unit, which is the sales per unit minus the variable cost per unit. So this is going to be our calculation. Fixed cost, something like the rent. So if we have the rent for the facilities that we need to be working in, and then we're considering the cost per unit. So if you're talking about like a restaurant for an evening or something, like what's the rent of the place that you got to pay? If it's $1,000, it is what it is. And then the sales price minus the cost per unit of the people that you're going to give a dinner to or something like that. You can then take the sales price, if it's $100 minus the cost, $20. You got $80 per meal. Dividing that into the costs of the facilities, the rent, would give you then the break-even point, the minimum number of people you need in order to break even for that event. All right, so let's break this out. And then, of course, that's the starting point, which you can build on to then and figure out how much profit you want to be building into a similar kind of format of a formula. So we're going to say the fixed costs are going to be the $30,000. Then we're going to be calculating the contribution margin per unit. So we'll calculate that. I'm going to put a subtotal here to do so. We're going to be taking the sales price per unit, not the total sales, but the sales price per unit, and the variable costs, those costs that change along with the increase in volume, which often includes things like materials and labor. If we sell inventory, or the cost of the meals, if we sell, if we're selling meals, but could also include things such as sales prices for commissions or something like that. Anything that will change with regards to increase in the sales volume. So we're going to pick up the sales per unit, the variable costs per unit. That's going to give us our contribution margin. So I'll put contribution margin. I'm going to get rid of the colon. And then we're going to say that this will be equal to, in the outer column, equal to the $30 minus the $16. Let's go ahead and format this thing, selecting these 3 cells. Home tab alignment, increase the indenting. Going to increase the indenting here again. Home tab alignment, increase the indenting. Let's put an underline under the 16. Home tab font group underline. Let's make these cells a little bit larger so you can see them. So I'm going to put my cursor right in between D and E. Make that a little bit bigger so I can see the units there. Then I could put an underline on the 14. Home tab, font group, underline on the 14 to finally get to that break-even point in units, our bottom line number that we've been looking for. That's going to mean that if we sell equal to the fixed cost, if we have fixed costs of $30,000, like the rent, divided by how much we're coming away with, sales minus the variable cost per unit, means that we need to sell 2,143 units in order to cover the fixed cost of the rent. You can see how useful this would be, hopefully, because then it's the starting point. If you want to see how much profit or how many units you need to sell to make a profit of so much, such say $10,000 profit, you can tack on fixed cost plus the $10,000, then see how many units you would need to cover not only the fixed cost, but also the desired profit of the 10,000. So we're going to go to the Home tab font group. Let's put the double underline, drop down and double underline here. Let's go ahead and prove it real quick with our net income calculation. Notice we're going to do our net income calculation not in the format of the normal income statement, which is like sales minus expenses or sales minus the cost of goods sold, gives us the gross profit minus operating expenses. No, we're going to use the contribution margin income statement, or at least that's what I would call it, breaking out the income statement costs, not in terms of what they're used for, as is the case of normal income statements, but in the case of the behavior of the cost. Do they increase and decrease with sales volume, or do they stay fixed? Are they variable in nature or fixed in nature? Therefore, we will have the sales minus the variable costs to give us the contribution margin, rather than sales minus the cost of goods sold to give us gross profit. So this will look unusual if you're not used to working with this type of income statement, but it's very useful. It'll typically be used internally when making these types of decisions. If you're looking at some other company and you're getting their financial statements, their public financial statements, it will not be in this format, but you could try to break it out into this format even with a public company if you're looking at some other company. If you're looking internally at the data and projecting what you want to do in the future, then companies will typically use analysis like this when doing projections because it's going to be easier to do so. So we're going to take then the sales. We'll take the sales. Let's break the sales out into the sales per unit. So we'll take the sales per unit, the sales price per unit, and then we'll take the variable cost per unit, and that's going to give us our total sales number. So the sales price per unit, we're going to say that that's going to be the $30. The variable cost per unit is going to be 16. I'm sorry, not the variable costs. We want to take that times the units sold. Okay, the units sold are going to be equal to the break-even units that we sold, because we're trying to prove that this is the break-even point. That means our sales are going to be equal to the $30 sales price times the units sold. That's going to be our sales item. Let's put an underline here, Home tab font group, and underline here. Let's go ahead and indent here, selecting these three. Home tab font group alignment, increase the indenting, and then I'll increase the indenting here. Home tab alignment, increase the indenting. I'll put a colon here to show that this is going to be a subgroup underneath it. It's just for some formatting purposes. Then we'll take a look at the variable costs. So the variable costs, we're going to say then, I'm going to say variable costs are going to be the variable costs per unit, and then we're going to multiply that times the units that were sold. That's going to give us our total variable costs. Variable costs. So this is going to be the variable cost per unit, which we said was 16, and those are the things that change with relation to the production level. And then we're going to say that the units sold are the same break-even point here. And then we're going to say the variable cost will be equal to the $16 cost times the number of units sold. Let's put an underline here under the units sold, Home tab font group underline. Let's go ahead and indent this now. We're going to select these three items. Home tab alignment, increase the indenting. We're then going to go to the variable costs, Home tab alignment, increase the indenting. This is going to give us our contribution margin. Contribution margin. And so I'm going to say then this is going to be equal to the sales minus the variable cost. Remember, not sales minus cost of goods sold, sales minus the variable cost, because we got our income statement in essence in a different format, that being, I would call it a contribution margin format. Now this is the contribution margin, not per unit, I should say here. This is just simply the contribution margin. Up top, we have the contribution margin per unit. Down below now here we have the contribution margin, which is the sales minus the variable costs total, as opposed to sales minus variable costs per unit. Let's go ahead and indent this. We'll keep that where it is. And then we're going to go to the fixed costs. So we've got the fixed cost then, which of course will be equal to the 30,000, because we're going to break even. That's what the point was. So there's the break even point, and that's going to give us then our net income, which will be equal to or plus the 30 minus the 30, bring us down to 0 because we broke even. That's what it means. And we don't have a loss or a gain. Home tab font, underline here. Let's put an underline here. Home tab font, underline there. Let's put a double underline here. Home tab font drop down double D underline. Okay, so there we have it. There's our break-even analysis. Now to do this, we need to break out our information to variable and fixed costs. This is not as easy as you would think for all costs. If you go through all costs, you're going to run into some costs that are kind of like mixed costs, whereas they have like a variable and a fixed component, meaning they may not go up directly with sales, but they have some kind of relationship to when sales go up, they go up. So what we need to do with those types of, the more specific or the better analysis we have with this type of analysis, we need to take those type of costs and put them in as best we can into these two categories so that we can then do an analysis that will be broken out by behavior, which is really nice for forecasting. So note there's going to be pros and cons with this type of analysis because it's not perfect, meaning almost no cost is exactly fixed or variable. For example, if you take the rent, it's fixed for a short period of time. But even if you have a 5-year lease contract on a building or something like that for the rent, it's variable after that point in time because you could then do something else after that point. So the fixed and variable, is a term that is really useful that we're going to categorize between them, but we really need to have those set two categories as if every cost fits perfectly into those two categories, and they do not. Therefore, we make assumptions in order to do so for predictive power into the future, knowing that as we do that, we're going to give up some specificity. It's not going to be as specific as it would, and there's going to be give and take in terms of our analysis between those two things. So if we go to the practice problem 2, we can think about the normal kind of breakouts between that we would have. So if we're breaking out our costs, if we look at our costs, like we look at the income statement, expenses, for example, and think about, are they going to be fixed or variable? Well, for example, the rent is the most common example of a fixed cost. So the rent is what it is. If you make more units, then the rent, you still pay the same rent. So if we have a warehouse where we make inventory, then if we make a lot of inventory, we still pay the $200,000 of rent, if that's how much we make. If we pay a little bit of inventory, then if we make a little bit of inventory, we still pay the $200,000. And so notice what happens when we say it's fixed. That means the total amount is fixed. So as you make more units, if you were to increase the number of units, you still pay the $200,000. Notice that if you try to allocate the rent to a per unit cost, then, which is kind of useful, you can imagine doing that, right? We're going to say, well, how much does it cost to make a unit of goods? If we're trying to allocate the rent to it, we're going to say, well, if we make 10,000 units, then, and the rent is 200,000, we can apply the 200,000 divided by the 10,000 units, and we're going to say it costs 20, we can allocate $20 of the rent per unit that we make. But what if we increase the number of units? If we increase the number of units to 20,000, then now the cost per unit actually got cheaper. So, and you can see how that's going to be a benefit, right? I mean, so if the more you produce, then the better you're utilizing the fixed costs. So if you're producing at less than capacity, then you're not fully utilizing the fixed costs. And if you can increase the level of production and be able to sell them, you'd be increasing the utilization. You could see this in things like a movie theater or a hotel pretty clearly here. If a movie theater sells 5 tickets in a 100-seat movie theater, then they're the cost of the rent of that theater per, if it costs $200,000 for the theater, then the cost per unit is higher than if they were to pack the movie theater. Then of course the cost per unit of the rent is lower. So obviously what they would like to do is have a packed movie theater because it doesn't cost them anymore and they have this high fixed cost. Hotels are going to be the same kind of way. The major cost of the hotel is the hotel itself. It's not really the maintenance on it. So if they have only a few people and a lot of rooms that are not rented, then the cost per unit of the fixed cost of the hotel is going to be higher. If they're able to rent out more rooms, then they're utilizing the fixed costs better up until they hit the point of capacity when they're full. Okay, so that's going to be that. And then we have the wages. are typically going to be a variable cost. Now, if you hear wages, that's a type of payroll. You can think of it as a type of payroll item. Wages are going to be things that are paid typically hourly. And so when we think about wages, you're usually thinking about things that are going to be done from a day-to-day time period. So if someone's being paid wages, the general thought is, well, they're being paid to do something specific, and so therefore you can allocate it. If it's wages to build inventory, then as you increase the number of units that you're making, you're going to pay more wages, and as you decrease the number of units, you decrease the wages. Now, obviously, wages are a little bit more sticky than that in practice, because if you hire someone and pay them even hourly, you've kind of have some commitment to how much, to keeping them on, even though they're an hourly worker, right? As opposed to a salaried worker, where you're going to be paying salary no matter what, right? So there is still kind of some sticky. We got to do as best we can to apply something out between variable and fixed. But the wages will typically say those are going to be the variable costs that we're going to apply to, the level of production possibly being put into the production process. Whereas the salaries here is often going to be allocated to like the administrative staff or something like that, and therefore will be fixed, meaning as the level of production goes up, then the salaries would typically remain the same. Now, we could have some step-up things like a bonus or something like that. If they go over a certain sales level, then maybe there's a policy that says they're going to give a bonus of some kind. And that means you're going to have some kind of step-up process, right? It's not really variable or fixed. It's like if you hit this line, if you go over that line, all of a sudden you're going to have a big step up. And so those are kind of some things that you can work into our formulas here between variable and fixed to try to get a variable component and a fixed component. You can adjust our projections based on that step up, basically, in those kind of situations. So that's just one example of where you don't have the exact variable and fixed breakout, but we're going to do our best to break it out between those two. And if we see alterations, like large arc alterations that will step up like that, we may adjust our projections and basically have another projection at that point, right, at that step up, and then go up from there, like we normally would. And then we got the raw materials per unit. This is like the most common example of a fixed cost. So the raw materials, and I'm going to make these adding decimals, highlighting these, home tab, or selecting them. Numbers group, add a few decimals there. So this is going to be the most common thing. So materials, if we make things, obviously as we increase the production level, then the cost per unit of materials, the cost total of the materials will go up. So let's think about that again. If we sold 20,000 units, notice that if we took the materials cost 2.7 times the 20,000, then the materials cost would be 54,000. If we sold 25,000 units, the materials cost would increase, right? We would increase. So if we made 25,000, made and sold 25,000 units, then the materials cost would increase to 67,000. So materials will increase with the units that we produce and the units sold typically. However, the thing that's a little bit confusing is that if you are asked what will happen to the raw materials per unit price as it goes up, right, it will remain the same. Meaning, if we made more units, that means the total is going to go up because the unit cost is the same per unit. Whereas, as we saw with the fixed costs, if we were to break it out into a per unit format, the fixed cost per units will actually go down. The variable costs will vary, meaning the total will vary. That's what it means when you say variable cost. The total will vary. Fixed cost means the total will stay fixed. But per unit, it's kind of like the opposite. The variable costs will stay the same on a per unit basis, whereas the fixed costs, as you increase, will actually go down per unit. So if we were then to sum these up, equals the sum of these items, and copy that across. There we have that. Let's add some decimals here. Home tab, font group, add a few decimals. Let's go ahead and put an underline here. We can go home tab, font group, and underline. We could double underline the bottom line. Home tab, font group, drop down in the double D underline.